Well, hello and welcome, Maverick traders. It's the 21st of March. Joe with you here on a Tuesday. Let's get into the market roundup as we're actually just waiting on the Fed announcement for tomorrow, right? That's kind of what it is. I've had lots of conversations with you over the last few days, and these markets seem to be definitely glass half full going into this Fed meeting. Maybe it's the worries about the bank that was immediately solved over the last few days. It just took about a weekend to resolve what could be something catastrophic. So it's just basically the pulse of these markets are very, very optimistic. Real quick, folks, what did we finish with? Dow and the S&P, the NASDAQ up higher. The NASDAQ just over 1.5%. The S&P just over 1%, and the Dow just shy of 1%, but very strong nonetheless, with the Russells being almost 2% as well. Oil had a pretty good shot to the upside, and gold actually slid pretty dramatically, which I would kind of expect when it comes to a flight out of safety and into confidence. Banking problems take a backseat to optimism in the markets. What I'm seeing is a lot of the bank and a lot of these problems when it comes to some of these banks overextending themselves and making some bad policies. We did see some strength and some dovish comments with Janet Yellen saying that, hey, we can take care of this, we can support this, we can ensure this, it's not that big of an issue. And it seems these markets shrug this off very quickly. Now that's short term. I don't know what's going to happen long term, but we are definitely pricing in a dovish Fed, thinking that maybe the Fed's going to see the fact that we had a little bit of a banking problem, and maybe instead of raising a full 50 basis points, maybe doing a quarter of a basis point or 0.25%. We'll see. It just depends on what they see. Now, when it comes to the disconnect of what we expect versus what the Fed expects, we are definitely leaning towards the optimistic side. Let's get to the advanced decline line. We got 74% advancers, 22% decliners, and 4% kind of going sideways above and below the 50-day moving average. You can see that we're still below in the majority of cases. However, the last few days have shown a lot of optimism. Let's take a look at the specific chart. So here's the SPY. And it's funny, folks, because if you take a look at what we've done over the last little bit, you would not expect this to be a market that is afraid of anything. In fact, the move that we saw off the bottom here with the subsequent volume would pretty much erase any sort of worries about banking situations. Now, guys, we're not facing anything that we saw back in 2008, but we are seeing some major banks become insolvent based on some of the decisions that they made. Whether or not you believe that it's just based on people pulling money out of the banks at a certain amount of time because of weakness, or it's something that this bank has done wrong. I don't want to go back to 2008 because it's nowhere near that. However, the SPY itself, which is very, very heavy in banks, absolutely shrugged it off like it was nothing. Let's get to the Qs, and you can see that the Qs were already moving higher regardless. This is something that, yes, of course, it's going to have to rely on banks, and a lot of people that don't think that it has to do with banks are wrong. It eventually will bleed over, but this absolutely ignored it. We had a pretty good hiccup here down below that 50-day moving average, but we've shot back up, and we are actually back to a point of retesting previous highs that we saw at the end of January with that subsequent rally at the beginning of the year. So where does this put us? Well, your guess is as good as mine. This is an absolute flight into investing. Confidence, glass half full, all sorts of stuff, whatever you want to call it. The only sector that was actually holding to the downside was utilities down here on the right. Past that, guys, I'm going to give it what I have to give it, which is a 0 for the short term, a -1 on the monthly, based on what I see technically. Now, what's really cool about this is you can definitely see the move that we had to the upside, and you guys can see that I am definitely at a 0 when it comes to the shorter term. But longer term, this is technically still in a very bear channel. Now, whether it's a bullish flag pattern has yet to be seen, but what I know is that I am above, or excuse me, at the top of a range that has been decreasing with the bearish crossover that you see here in the 20 and the 50-day moving average, seeing that we actually hit the 50-day. I have to be very bearish. I have to be bearish in the longer term, meaning this might not hold regardless of what happens tomorrow, what the Fed does, and how the markets react to it. I'm just trading this technically. Now, in the shorter term, I'm going to respect the fact that we are at this upper channel, and if something happens when it comes to the fundamentals of the markets, I might change my tune rather quickly. The goal thing is I don't have to make too big of a decision today or tomorrow. So I truly believe, folks, that the big weight is going to be on the Fed, what the Fed says, and more importantly, how the markets react. This is a market that is absolutely against any sort of bearishness. It has completely been against the Fed's decisions on increasing interest rates. It thinks that the Fed is overreactive. It is absolutely trading well above the expectations of any sort of recession or slowdown in the economy. That is apparent. If you guys don't know what I'm talking about, just take a look at the chart since January 1st to today. This is a market that is not afraid of a slowdown or a recession or any sort of worries of job losses. It has not been happening. A lot of the things that we are seeing in these economic reports do support that. So the markets are already positioned for a dovish outlook. We are already well above levels that you would expect when it comes to fear. We have the FOMC announcement tomorrow. That's going to have the biggest impact on the markets. We don't have much past that when it comes to economic news. We'll see how the markets deal with what the Fed says and how it digests that information and what it does. Earnings reports wise, we got Nike, GameStop. They're both out. Nike's down a little bit. GameStop is up. You guys can go through and divulge that news for what you want to get out of it. Check potential trades for any sort of earnings announcements. You guys know the deal. So, all right, folks, take responsibility for what let's take a look at what the Fed has to do tomorrow, and let's see what it does. Let's see what those numbers are. Let's see what the Fed does, and let's see the reaction of the markets more importantly. All right, folks, thanks for joining me. We'll talk to you next time.